Hello everyone, my name is Blaine Pearson and I am a graduate instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at what a cash flow statement is. So when we think of cash flow statement, it is literally, as the title suggests, a cash flow statement. So what I mean by that is the cash inflow, right, which is any kind of income source. This can include salary, interest income, royalty income, any kind of income, farming income, etc. that you may have. And then the other part of the cash flow is the cash outflow. So this represents our expenses, both variable and fixed. For those that are still a little fuzzy on what a variable and a fixed expense are, I have a video that is coming out very soon to explain the difference. The cash outflow, which includes savings as well. So when we think about cash outflow, right, we have to pay ourselves, right? So we can treat that as an expense that we can utilize and categorize as a cash outflow. And when we take our inflow and we minus and subtract our outflow here, we get our unidentified cash flow or our surplus deficit. So when we think of unidentified cash flow, there's really no such thing as quote-unquote unidentified cash flow. It's not like it just magically appears and you say you have an unidentified cash flow of $4,000 and the client says, great, where's it at? Nope. So when we talk about unidentified cash flow, you can think of it as almost this kind of idea, almost this ghost kind of item. The unidentified cash flow is captured in items such as increases on the balance sheet and that kind of thing. So that's why when we take a look at the cash inflow and subtract from the cash outflow, we may see a surplus, and that's, yes, identified cash surplus, but it's not like, we're just writing them a check or they're just getting a check for that. And so any time that we have a cash inflow that's greater than our cash outflow, that is a surplus, that is excess cash. So when you hear someone say that they have a cash surplus, that means that they actually generated more income than expenses. Now, a cash deficit, a cash flow deficit, is when just the opposite, right? So you have cash outflow, right? You're spending more than what you're generating in income, and in financial planning, that is a no-no. So when we take a look at the actual cash flow statement, right, the statement itself, it presents it over a period of time. It's usually for a year, and we usually analyze it for an entire year. So that means we're going to have to project out part of the year. So say the clients come in August, we need to analyze it on a yearly basis. It makes more sense when we're dealing with financial planning to look at annualized cash flow rather than weekly or monthly. So let's move on. I just want to make sure we nail this point home. Our cash inflow, right, we just talked about that, our income sources. We subtract our cash outflow, and this gives us our cash surplus or our cash deficit, right? So money that we have, that's green, that's a surplus. Deficit, bad, red, okay? And you can use these two terms kind of interchangeably with unidentified cash flow. It's just kind of a generic term used to describe either a deficit or a surplus from your cash flow. And again, we just talked about this unidentified cash flow because in real life, right, you may not be able to trust the data, right, because there could be a situation where the clients may be misreporting their cash outflow, right? Like, Mr. Johnson, I'm pretty sure you spend a little more at the liquor store than $100 a month. So, they may not report, your clients may not report, right, quite accurate, and your data will ultimately affect the numbers as a result. So now how do we organize this? Well, let's take an example. So when we think about our housing expense category, right, these include mortgage payments, homeowners insurance, real estate taxes, etc. Now, what about cable and internet? You could consider this a housing expense, right? But cable and internet could also be considered with entertainment expense. So the reason I included this in red here is because you can see this in both categories. This is really user preference and client preference as to how they think about it. Some clients may think, oh yeah, cable and internet, that is just an entertainment expense. We treat that like we would going to the movies or something like that. Some clients treat it as, nope, cable internet, that is a utility like water and gas or electricity, and that is something that is a staple and we treat it as a Now let's move over to an actual statement of cash flow. So this is a statement of cash flow for two clients here. For Robert, looks like he has his income sources here from both his base salary that he's earning, his legal consulting here, and then looks like he's also getting a small benefit from his child Social Security benefit. And from here we take the summation of all those cash inflows and outflows and we organize it into this category here at the bottom. This is the total inflows. And then we take our outflows, right? We've talked about, savings, and then here we have our expenses, etc. From there, we're going to, with expenses, create a couple subcategories. Ordinary living expenses, these include things like food, clothing, phone, internet, etc. Our debt and interest payment obligations, our insurance premiums, and our taxes. And we'll include a miscellaneous category, for example, for like a one-time car down payment or something like that. We may want to separate that and keep that off. So here we have the total amount that these clients are saving every year. We have the total amount they're spending on their what are they doing every day to keep their life going. How much are they spending in debt and interest? How much are they paying in taxes and insurance? And we sum all of this up for 2018, and this gives us our total outflow category. What we can then do is take our total cash inflows, so this 185 number, and we can subtract it from this 180 number, and this is this unidentified cash surplus deficit that I talked about earlier. So we looked at what that term meant. If you need to rewind, please do so. But this $5,000, we can tell the clients, okay, great. That means you're not overspending. That means that, after your planned savings contributions, there was about $5,000. It may be misreported in the data, or you may, see changes from that $5,000 in, let's say, an increase in your checking account balance, which we can then move over to the balance sheet and verify that if needed. Now, what you all may see over here is this other category on the far right. So what this is a life insurance proceeds, and maybe they had a death in the family or something of that nature, and they received this nice life insurance proceeds. So what I always like to do is anytime there's this kind of like an inheritance or one-time income, maybe a winnings or something like that, I never like to present that in with what they would normally earn every year, because it's not really accurate. They're not really going to bring in $365,000 a year. Like, we can't go and report to the client that, oh yeah, you're in great financial position. You have $185,000 in excess cash flow. You can go and make it rain now. No, that's not what this category is. That's not what we can tell the clients. What we can tell the clients is, look, this is what it normally looks like. You have this one-time outlier income, and here's how it affects, right? It did not affect your cash outflow, right? The only thing it did is you had this one-time income, and we can see that income and changes on the balance sheet. And I like to do that to make sure clients don't get confused and they don't say, oh yeah, 185, I'm in a good position, when realistically what that number is going forward, and what it should have been this year outside of this one-time income is much, much and significantly smaller. Again, this is Blaine Pearson, and in this video, we examined what a cash flow statement is. Thank you for watching.